Gold hit an all-time high in October 2024. Then something broke. Not the price. The price kept climbing. What broke was the logic underneath it. The confidence. The math that everyone had been trusting for decades. And if you think this is just about shiny metal bars sitting in vaults, you're missing the point. This is about what happens when the thing we use to hedge against chaos becomes chaos. Let me show you what I mean. Here's what you need to understand first. Gold isn't just a commodity. It's not like oil or wheat or copper. Those things have uses. Gold is a belief system. You can't eat it. You can't burn it for energy. You can barely build anything useful with it. But for thousands of years, humans have agreed on one thing. Gold is worth something because we all say it is. That's it. That's the entire foundation. And for most of history, that worked fine. Empires rose and fell. Currencies collapsed. Governments printed money until it was worthless. But gold? Gold stayed gold. Rare. Tangible. Hard to fake. Hard to inflate. So people trusted it. Central banks hoarded it. Investors bought it when stocks crashed. Survivalists buried it in their backyards. Gold became the thing you run to when everything else falls apart. But in 2024, something changed. Let me take you back to March of that year. Silicon Valley Bank collapses. Then Signature Bank. Then Credit Suisse, one of the oldest names in global banking, gets emergency absorbed by UBS to stop a full-blown panic. Classic setup for a gold rally,
Look at
right?
all this
Fear
treasure!
spikes. Trust evaporates.
Keep it
Money
a
flows into
secret!
safe havens. And sure enough,
We
gold starts
finally
climbing.
did it!
$2,000 an ounce, then $2,100. By October, it smashes through the 2,700. Everyone cheers. Gold bugs feel vindicated. See, they say, we told you fiat currency was a scam. But here's where it gets weird. Normally when gold rallies like that, it's because people are scared. They're buying physical bars, coins, anything they can actually hold. This time, physical demand was fine, not weak, but not exploding either. So where was all this buying pressure coming from? Futures contracts. And if you just felt your eyes glaze over, stay with me. This is where it gets interesting. A gold futures contract is a promise. You agree to buy or sell a certain amount of gold at a certain price on a certain date. You don't need to own the gold. You don't even need to want the gold. You just need to post a small amount of cash as collateral and boom, you control a massive position. It's leverage. And leverage is gasoline. Now futures markets exist for a reason. Miners use them to lock in prices. Jewelers use them to manage costs. It's a hedging tool, but in 2024 something else started happening. Central banks, especially in China, Russia and India, started buying gold like never before. Hundreds of tons, not futures, actual physical gold. At the same time, Western investors, hedge funds and algorithms started piling into gold futures. Massive positions, billions of dollars in paper exposure. And here's the thing about paper gold versus real gold. There's way more paper. Estimates vary, but many analysts believe that for every ounce of physical gold that actually exists in vaults, there are somewhere between 10 and 100 claims on that same ounce in the futures market. Think about that. It's like a game of musical chairs, except there's one chair and 100 people playing. And everyone assumes they'll never actually have to sit down. So why did this work for so long? Because most futures contracts never settle in physical delivery. They're cash settled. You buy the contract, ride the price up or down, then sell it before expiration. You never touch the gold. You just trade the idea of gold. And for decades, that was fine. The system hummed along. Physical and paper prices stayed mostly in sync. But in late 2024, the gap started to widen. In London and New York, where paper gold trades, prices kept rising. But in Shanghai, where actual physical gold changes hands, prices started climbing even faster. A premium appeared. Not huge at first. A few dollars per ounce, then 10, then 20. That's not supposed to happen. If gold in Shanghai costs more than gold in New York, arbitrage traders should jump in. Buy in New York, sell in Shanghai, pocket the difference. The premium disappears. Except it didn't disappear. Because there wasn't enough physical gold to move. Let me explain why this is a problem. Imagine you own a casino. People come in, place bets, win some, lose some. You pay out winners with chips. Everyone's happy. Now imagine one day a bunch of people walk up to the cage and say, Actually, I want cash. Not chips. Cash. And you realize you don't have enough cash in the vault to cover all the chips in play. That's what started happening in the gold market. For years, the paper market worked because almost no one asked for delivery. It was all just trading. Speculation. Hedging. But when central banks started buying physical, when geopolitical tensions made people nervous about counterparty risk, when China and Russia explicitly said they wanted to reduce dependence on Western financial systems, suddenly people wanted the actual metal, and there wasn't enough to go around. This is where things get absurd. The COMEX, which is the major exchange for gold futures in the US, has a system called registered and eligible gold. Eligible gold is metal sitting in COMEX-approved vaults. It's there. It exists. But the owner hasn't made it available for delivery. Registered gold is metal that's actually available to fulfill contracts. In October 2024, registered gold in COMEX vaults dropped to some of the lowest levels in years. We're talking about less than 25 million ounces backing a market with open interest worth hundreds of billions of dollars. Do the math. If even a small fraction of contract holders demanded delivery, the system would seize up, and people started to notice. Here's the irony. Gold is supposed to be the safe asset. The thing that doesn't rely on anyone's promise. No counterparty risk. No central bank that can print more of it overnight. But the modern gold market, it runs on promises. Promises that there's gold in a vault somewhere. Promises that if you want it, you can get it. Promises that the price you see on your screen reflects reality. And in 2024, those promises started to crack. Not loudly. Not all at once. But enough that people inside the industry started whispering. Whispers about delayed deliveries. Whispers about vaults shuffling inventory between categories to make the numbers look better. Whispers about whether the gold some institutions claim to own actually existed. Now, I'm not saying there was fraud. I'm saying there was doubt. And in a market built entirely on confidence, doubt is poison. So what actually imploded? Not the price. Like I said, gold kept going up. What imploded was the illusion that the market was functioning normally. You had a two-tier system. Physical gold for people who could move tonnage and had the infrastructure to store it. And paper gold for everyone else. And the gap between those two worlds started to show. Some analysts called it a bullion squeeze. Others called it a structural dislocation. The polite term is market stress. But here's the simpler version. Too many people held tickets to a show that didn't have enough seats. Now zoom out. Why does this matter if you're not a gold trader or a central bank? Because gold is the canary in the coal mine for trust. When people stop trusting their currency, they buy gold. When they stop trusting their government, they buy gold. When they stop trusting the financial system itself, they buy gold. So what does it mean when the gold market, the ultimate trust fall asset, starts showing cracks? It means we're stress testing the foundations. The global financial system runs on layers of abstraction, derivatives, rehypothecation, fractional reserves, promises stacked on promises. Most of the time it works. Everyone stays calm. No one asks for their money at the same time. But every once in a while someone pulls a thread. And you realize how much of it is held together by vibes. Here's what happened next. Regulators didn't panic. Exchanges didn't blow up. The COMEX didn't default. Instead, things just adjusted. Some contracts got rolled. Some got settled in cash instead of metal. Registered inventory ticked up slightly as vault owners shifted categories. Premiums in Shanghai stayed elevated but didn't spiral. The system bent. It didn't break, but it bent. And the people paying attention took notes. Central banks kept buying. Retail investors kept stacking coins. And a growing number of analysts started asking uncomfortable questions about how much of the gold market is real and how much is performance art. Let me give you one more number. According to the World Gold Council, total above-ground gold stocks, everything ever mined in human history, sits at around 208,000 metric tons. Sounds like a lot, right? Here's the thing. If you melted all of it down, it would fit in a cube about 72 feet on each side. Roughly an Olympic swimming pool and a half. That's it. That's all the gold in the world. Every wedding ring. Every bullion bar. Every central bank reserve. Every sovereign wealth fund holding. Now think about how many financial instruments claim exposure to that same pool. Futures, ETFs, certificates, allocated accounts, unallocated accounts. The leverage is staggering. And as long as everyone's playing the same game, trading paper, settling in cash, never asking questions, it works. But the moment someone steps outside that system and says, "No, I want the actual thing," the music stops. So here's where we are. Gold hit record highs. The market didn't collapse, but it also didn't work the way it's supposed to. And that gap between what the market says and what the market can actually deliver, that's the thing people will be watching in the years ahead. Because the next time there's a real crisis, when banks are failing or currencies are cratering or geopolitical tensions boil over, and everyone rushes to gold at the same time, we're going to find out if there's enough to go around, or if we've all just been trading pieces of paper with a picture of a gold bar on them. There's no clean ending here, no solution, no hero who fixes everything. The gold market is still functioning, prices are still rising, people are still buying. But something shifted in 2024. The curtain pulled back just enough, and once you see how the trick works, you can't unsee it. So, the question isn't whether the gold market imploded. The question is, what happens when everyone figures out it almost did?